We usually think of food security as a purely physical equation: stable weather, healthy soil, and the heavy machinery required to harvest a reliable yield. But those physical assets are inert without a hidden, non-physical input: continuous, stable credit. Farming is a business of seasonal delays. You buy inputs today, but you aren't paid until months later. Bridging that gap requires a constant flow of borrowing. That flow is threatened by a financial mechanism called the sovereign bank doom loop, currently tightening its grip on nations like Greece, Italy, and Portugal. This loop acts as a parasite. While governments struggle with national debt, the resulting instability severs the credit lifelines farmers across the continent use to plant their crops. Based on current debt trajectories, this financial cycle is on course to trigger severe food shortages. If the loop remains unchecked, it marks 2032 as a definitive turning point for the survival of the European Union. Tracing the tack from a banking crisis to an empty grocery store requires looking at the national treasuries of heavily indebted nations. The doom loop starts when a government issues bonds to fund itself. In economically vulnerable countries, domestic banks buy up that risky sovereign debt, linking their own stability directly to the creditworthiness of their home country. When the sovereign debt crisis worsens, confidence evaporates. Capital flees the country for safer markets, draining the lifeblood of the domestic economy. This flight triggers a liquidity crisis. Domestic banks, seeing their capital reserves vanish, freeze their lending operations to stay afloat. Because a debt crisis breaks the domestic banking system, it effectively sets a lethal trap for every industry that relies on seasonal loans to function. As credit freezes at the bank, the impact moves from the balance sheet to the soil. Farmers facing severe credit tightening lose the ability to pay for the seeds and labor needed for the season. Without a loan, they cannot plant. Simultaneously, the national government has lost the fiscal capacity to help. Consumed by debt, these nations are forced to cut the agricultural subsidies and energy support systems that usually keep food prices stable. Farmers are caught in a vice. Denied bank credit and stripped of government support, they must absorb surging fuel and fertilizer costs entirely on their own. The only remaining option for survival is to shrink. Farmers reduce their output, leading to a massive contraction in the total food supply. This financial strangulation engineers a physical supply crisis. The scarcity eventually triggers a violent price rally in essential commodities like wheat. Europe is currently approaching a critical temporal threshold where these internal financial pressures meet external global risks. Analysis of long-term trends points to a major convergence heading into 2032. This is where the sovereign debt cycle is expected to intersect with major climate and war cycles, creating a multidimensional threat to food security. History shows when wheat prices spike above 300%, social stability ends. Every major spike past this threshold terminates in revolution within 18 months. As debt limits a government's ability to intervene, crossing that 300% threshold becomes a calculated risk for the continent. When basic sustenance becomes unaffordable, the resulting bread riots and civil unrest challenge the core function of the state. By the 2032 turning point, the European Union faces a terminal threat to its current structure. A financial loop that prices its own citizens out of their daily bread creates a level of instability that policy reform alone cannot solve.